All right. Welcome back, everybody, my unique traders. Listen, I got some very exciting information for you on the market today, more specifically SPY, and of course, the broader market. But I tell you, today was very interesting, and I want to dive into what to expect for tomorrow and the overall outlook for Trump coming in next week on the 20th, getting inaugurated into office and things of that nature. And so there is a certain psychology and a certain sentiment around the market around these times, all right? And just knowing that, added with the technicals on a chart, I think that we're in good shape, all right? So we're going to give some details out and some insights on SPY. And remember, tomorrow is Opex Friday, options expiration. So that's what we're going to base our video on. And before we get started, I want to hop over to the economic data for tomorrow. Today, actually, we had unemployment claims, retail sales, and core retail sales. Came out a little bit lower than expectations. Market was a little bit choppy today, back and forth, of course, which is expected up until the end of the week. And of course, tomorrow we have retail sales at about 2 a.m. in the morning. All right. Other than that, market open, we have some CB leader index information and a capacity utilization rate. All right. And so other than that, we don't have any more red folders, volatility folders. And so that's what we have going into tomorrow. So let's go ahead and hop over to the Discord. As you guys know, I love to give the Traders Creed out and read it with you guys live as I'm recording. Why? Because it helps with the psychology of a trader. And I want you guys to get used to memorizing this, all right? So from the top, let's go ahead and start. The Traders Creed. I am a consistent winner because I objectively identify my edges. I predefine my risk of every trade. I completely accept the risk, or I am willing to let go of the trade. I act on my edges without reservation or hesitation. I pay myself as the market makes money available to me. I continually monitor my susceptibility for making errors. I understand the absolute necessity of these principles of consistent success, and therefore, I never violate them. All right. So this is the Traders Creed. You're familiar with it, save it, study it, and try to memorize it, okay? All right, now let's hop into the charts. I don't want to hold you guys much longer. That's what you came here for, right? All right, now listen, we are on the daily chart. What do we have in front of us? Now, I mentioned in a couple videos back that we were going to have a bear trap, all right? That was back on the 13th of January. I'm sorry, that was Monday. Okay, you're right. Yeah, the 13th of January, about 3 days ago, I posted a video on YouTube explaining that we could get a bear trap. All right, we got that bear trap here. And since then, we've bounced from 576 all the way up to 593. All right, almost a $20 move. And so if you watching my videos, if you study my videos, and you understand auction theory and gamma squeezes, then you would be able to make some money just based off my videos alone. And if you want to join my Discord, the link is below in the description, where you can gain either further insights besides my YouTubes. But we got that, right? And so we're past that now. And now we're up here. We've created a gap. There's a gap between 580, 589 and 585. A good 3-4 risk to reward ratio. Gaps do get filled. I can't say when the gap will get filled, but I will say that I would watch your calls if you are in swings, or if you're trying to take a swing, a call to the upside. 589 would be the place for you to cut those trades, okay? If it acts as a place of resistance, yes, I would cut those trades, which is ironic because 590 is actually a line in the sand, just like 580 was, all right? But now 590 is the line in the sand, right? 590, 595, and 600. These are the expected moves to the upside, okay? All right, so tomorrow we have Opex expiration, and I want to explain this to you guys, okay? Usually on a Friday there's low volume, or there's hedging for market makers. There are some contracts that are going to expire worthless, And there's going to be some folks who are going to be selling premium and doing all types of option strategies on the market that you might not be familiar with. There are 400 option strategies. 400 option strategies. Most people only utilize a few of them, but there are way more, okay? And once you get more advanced with this, you can understand how to implement certain strategies. Right now, I have a synthetic straddle on SPY. I have a put and I have a call, right? And I'll go into further details about that in another video. If you want me to just comment below, or like I said, join my Discord and check out some of the sections we have and we can explore further. So how are we going to go into tomorrow with it being Friday? Well, let's make it really simple. Right now we are above the 21 SMA. If you don't know, the 21 SMA is my trigger for calls and puts. I like high probability setups, and I use the 21 as a measure. And sometimes you don't always have to use that. As you can see here, we are in this big box range here that was created since 607, 609, and we fell here, broke past this range of 603, and we've been in this little box area for a while now. All right, in this area for a while now, and these areas move without being above the 21 or below the 21. Obviously it's below here for puts, below here for puts. But I told you that we're in a downtrend before. All right, we do have higher lows. Judging from the daily here, this is a higher low, right? But we have lower highs. So we are in this indecision mode right now. All right, and a lot of that is due to Trump coming in office. A lot of people are sitting on the sidelines waiting, right? They also want to drive price down so they can get the best price, because retail traders like me and you, we can't make these big moves in the market. The big players, the big money has been creating these. So you can bet that they're waiting to pivot to make a move before Trump get in office. That's what's going on here, okay? So on the daily, now we did fall back to 591, even though we reached 593 yesterday. We teetered with these prices, but we are still above the 21. The oversold and overbought indicator looking like a little bit of oversold, right? The last time we were here, oversold, check my screen, we rallied up to the upside. All right, how many points was that? 576 to 600. All right, we're oversold a little bit. We're above the 21. All right, and so what can happen tomorrow is that we can stay in the range, right? The range is the low of 590.93 and the high is 594.35. I'll say that again. The low of the current candle on the daily is 590.93 and the high is 594.35. These should be the numbers you want to watch. So let's put our lines together. I'm going to put a green line at the 21 at the low, because once I toggle down away from the daily to the hour, the 5 or the 15 for my entry levels, this green line I want to see is to represent me buying calls once I see it react. Okay, I want to put a red line, horizontal line, right above this candle here for the high of 590.93. Let's change that red. And so what I'm doing is I'm watching for a reaction around these numbers. That way I have a trading plan. All right, we're marking up our charts. The midway point, the 50% mark in this auction, is about 592. Okay, 593 is an algo number for calls that I mentioned way back when here, and also it acted as a algo number for calls here around 593. Okay, and so if I get a break above 593 and hold, I want to target the next area of 595 and 598 for a swing. Okay, that's just how I do. I want to use a stop on that, a tight stop, only if we get above 593 and 594, because these are acting as resistance. And as long as we have these, right, these are lower highs, lower highs, lower highs, we still can reject from here. We still can reject from 594. 594 is another line in the sand for a decision-making moment. All right, that's when gamma meets the market makers and they have to hedge. All right, that's when buyers and sellers have to make a decision to agree on price to create balance in the market. And once you have balance in the market, that's when price can continue in the trend that it wants to continue in. So, just to recap, we are on a daily chart. We don't want to take any calls, to try any calls, right? Unless we are above 593. I'm sorry, 594.35. We don't want to take any calls unless we're above 594.35. And I don't want to take any puts unless we are below 590. 590 is the line in the sand, okay? 590.93, around this area. And I want to be clear, when we get to these numbers, it doesn't mean immediately buy a call or immediately buy a put if price fails below 590. You ought to wait and react, right? Check your time frames, check the economic data, make sure there's no earnings, make sure that you have a confirmation of a close price at these numbers. 590 is a line in the sand, but if it fails and acts as resistance, I want to target these numbers down here. Now we're right here. I want to target 589, right? And you see how this could be a place of balance where people take their profit and we can bounce back, all right? That's not a good favorable risk to reward. This is more like a scalp, all right, from 590 to 589. I don't like that, right? I'd rather wait for it to break this low of 589 so we can fill this gap here. That's the best risk to reward for puts, to fill the gap down to 585. That's a 3 to 4 risk to reward ratio for puts. For calls, what I want to do is I want to wait for a break of 94.35 on the daily, for it to break and hold, for me to take calls all the way up to 595, 597, 598. Now, I won't go any further than that right here at this 598, 599 line because we haven't got there yet. Okay, but of course, if we do, we can make our way up to these all-time highs again, 605, which would make sense with the ATR calculation on the monthly and quarterly for the ironic Trump inauguration. All right, let's go down to the hour time frame. And when we're done with this hour time frame, I'm going to show you some pretty cool things to explain to you why Opex expiration is very important for you to understand. And we do have Opex tomorrow. All right, Opex is tomorrow. Now I have a Fibonacci up here. If you're not familiar with Fibonacci, they're just extension points for price, pivot points. It's all symmetrical and it's all mathematical. Sometimes you take the price from the lowest point, and I did this on a daily. You take the price from the lowest point and you move it up once you get a pullback, and you stop your zero line right here, your zero line right at the top of price where it rejected at. Now let me circle the zero line for you. You might can't see it. All right, the zero line is right there. All right, and that's the fib extension. I'll go in detail about this in another video. Bear with me as I explain to you these charts. All right, indicators are okay, but price action and structure is better. So now that we're on an hour, you see some of these same setups that we've seen on a daily. I want to use a volume profile, which is a future forward thinking indicator. All right, and right now we have a volume shape P, the letter P. The letter P can mean two things. It can mean bullish continuation above the point of control. All right, let me make this a little bigger for you. All right, these gold and blue bars are the volume control. All right, it's a future forward thinking indicator, not like a lagging moving average indicator. It's future forward thinking. You can do your research, Google it, or ChatGPT it. And what I'm looking for most specifically is for this red line right here, which is the point of control, is at 592. All right, this would be a trigger right here if it reacts on any time frame, tomorrow, next week, Monday, anytime next week. All right, 592 could act as a point of control for the bulls to gain momentum. That's just a second area of momentum. The first area of momentum on the hour will be 591. 591.66. Yep, 591. Yep, 591.66, 591.85. Right in that area, right above my 21 call trigger. Okay, that would be the next call trigger on the hour time frame. Right now we are below it. We are in between the Bollinger Band and the 21. And so what I want to do is wait patiently. I don't want to do anything. As I stated before, I have a synthetic straddle on the market, a put in a call. So it doesn't really matter what the market does. Next week, when volatility persists and the balance of the market can come back, once the noise is out of here, then I can adjust my positions and add and or subtract from my positions depending on what the market does. Okay, so here we have a gap on an hour. Okay, this gap can very well must be filled. Why is that? Let's scroll down. Now, I talk about bear traps and bull traps pretty often. Like I mentioned before, early in the video, we got a bear trap right here. All right, we trapped in the bears the same way we trapped them here. You see, these are all bull traps, right? At the top here, bull trap, all right? And so right now we have a head and shoulders pattern, all right? Doesn't have to play out, doesn't have to shoot to the upside, and it does not have to go to the downside based on the head and shoulders, okay? I'm only telling you this for you to be aware of the other scenarios. It's very important, guys, for you to have a trading plan and always define your risk, your entry, and your exits before you take a trade. That's why it's good to mark up your charts, go over some technical analysis, and continuously learn. All right, find you a good mentor and stick with them and study hard. That's what I did for several years. I lost money, but it was a price of tuition that I had to pay in order to get the knowledge and the insight that I needed in order to trade. Okay, so don't give up. All right, so let's get back to the charts. Like I said here, this is a gap. So if we stay below the 21, tomorrow as price does what it does and you see a little bit of pressure maybe to the upside, or you wake up in the morning and SPY is down. Now this is a overhead resistance line. All right, price breaks this line, I'm going to be bullish. Okay, price breaks below here, the last price of this range right here, I'm going to take puts to the downside on the hour. All right, I'm going to amplify my puts that I already have. If it goes below this price of 590.29, if it breaks to 590.29 on an hour, I'm going to add to my puts and I'm going to cut my calls, and I'm going to take my profit at 585 for the gap fill. Now, if it fills the gap, it could be a gap fill reversal. Let's do the animation. It could be a gap fill reversal, right? Or it could be a gap fill and go. All right, to retest these lows here. Now, why do I say that? Why do I say retest the lows? I want you to be prepared. I want you to be prepared for this, okay? The reason why I say that we could retest those lows, because think about it. If you were a bull, right, just like here, right? If you were a bull and you got in at the lows, the best risk to reward, right? You didn't let the news sway you, right? You understood price action and market structure, right? You understood that liquidity could be trapped. You understood that amateurs are here buying puts at the lows to sell the market. We buy when they make that mistake because it's a high probability setup and a self-fulfilling prophecy where gamma meets the squeeze and delta, and market makers have to hedge right there. They would take their profit up here if they got in here. Then this will be the high point of the parallel channel and they take their profits. Same way it's happening here. The bulls got in here. I took calls here. I told you guys about it. All right, and we took our profits right up here around this area. And so what do you think the bears want to do? Well, the bears are trying to get it back down here all the way to these lows so that they could take it back from these lows to take it up to the highs. And that's what we are looking for. Okay, we're looking for that price, and we can trap in liquidity right here at this area here. So just understanding the psychology is what we need. The bulls don't want to really buy high. The bulls also want to buy low for the best risk to reward ratio. The best risk to reward ratio. Okay, and if you know that, then you can wait patiently, understanding that there's a gap here, right? There's a gap. If the gap fills, it's a possibility that we could retest these lows the same way we did here. All right, there was a gap here. We chopped around here the same way as my little choppy illustration here, and we fell to the lows. That does not have to happen, but it's a scenario, and I do urge you guys to be prepared for different scenarios, because this could be a bull flag here. This could be a whole bull flag. All right, this could be a ascending channel bull flag. All right, to retest these Fibonacci levels, 599. All right, and that's what you're looking at. Okay, these are the scenarios that you could get, and so I want you to be prepared. All right, now I'm gonna quickly go to the intraday time frame of 15 minutes. Don't want to hold you guys too long. Entry day. Let's say tomorrow, the market opens up and we just so happen to, let me take this volume profile off. Take all the drawings off. All right, make it bare, okay? Let's say tomorrow we wake up and price is at this high. For whatever reason, we're at 595. I teach my students and my mentees about the auction theory, okay? Auction theory. 0, 50%, and 100% mark. There are only 3 levels to trading, 1, 2, and 3. Where are we in the grand scheme of things? You have a small area range here, and if you squeeze in the charts, you see a bigger range, okay? See a bigger range, all right? And so all these represent thirds in the market, all right? You have the 0, have your 0%, have your 0% here. You have your 50% here. All right, you have your 50% here. All right, you have 50% right here. Now, what am I getting this 50% from? This whole box represents a 100% move. So the midway point would be 50. All right, we'll make this complicated. Let's keep this simple, okay? All right, but I'm going to show you something, and this is just one way to look at the market. Because a lot of people have their strategies and they're afraid to do different things, but I think the best way to trade is the most simplest way to trade, all right, with an edge, all right, knowing what the market eternals are, all right, and this is a casino, this is an auction, all right, so we are teetering right here at this level around the 50% mark. Now, why is this important? Because this right here creates this price action that we talked about. If we wake up tomorrow and the price is here at 595, all right, I wouldn't rush for anything because 595 could fail. All right, we still have overhead resistance right there. Okay, so we could very well get above the 21 SMA right here, come up here tomorrow and reject again. So if you wake up in the morning, 9:30 bell opens, you're like, man, I'm going to take a call. Just remember that we could resist right here and fall back to the low, so be careful. The best risk to reward on the 15-minute was to be taking calls above 591. We talked about this number earlier on the daily chart and the hour chart. So I would want to take a risk on the entry day, right, above 591, 591.79, 580, really 590.50. Okay, and I would want to take a call, a quick 2-to-1 risk to reward up to the Bollinger Band of 592. That's a scenario, okay? But I will be cutting my calls then. But we don't know what's going to happen tomorrow when we wake up. Pre-market could happen. We could fall, fill this gap. We could fall back to 590, which would be another line in the sand, a algo demand level, right? The same way it acted around here, okay? So that's what we want to wait for. Now, if we do fall below the 50% mark, then we could fill this gap and possibly go back down here towards 575, 577, okay? And that's a scenario. Other than that, if we fall anything below the lowest highs, which are 570, we could see 560, 550, even 540. That's just the truth, okay? And that's what you ought to look for. These are your metrics, 0, 50, and 100%. Now, there's something called max pain. And max pain is going to happen tomorrow with Opex expiration. And so we're going to navigate over to barchart.com, BARCHART, to talk about max pain and why that 590 and 591 levels are very important for tomorrow for you to watch. Okay, we're on bar chart. This is the max pain for SPY. Okay, tomorrow is going to be here and we're going to be able to refresh this page. All right, but for now, we're still on the 16th. And so that's what we see. And as you can see here, the max pain is 591. And where did we close at today, guys? Where did we close today? We closed today at 591.64. Now, do you think that's ironic? Or do you think that this is a mathematical matrix? Ask yourself that. All right. So that's why you can wait patient to understand that 590 and 591 is the line in the sand. And once we pop below 590, like I mentioned earlier in the video, 589, don't rush into puts. Wait for confirmation on your entry time frames for it to break and close below. That's when you would target the next auction numbers, the 100, 0, and 50% levels. So you guys are smart. If you're doing a 100% level, then there's 3 levels to measure: 0, 50, 100. If 590 acts as resistance, that is your 100 line. And so if we fall to the 50% mark, that would be 585. Are you with me? Now I'm going to go to the charts and show you that, and we're going to end this video, but I want you to see the gamma exposure here for SPY. Gamma, we have, now you see these blue lines above. Now if it's above, these are for calls. If it's below, it's for puts. We have put gamma exposure at 580, 585, and 590. Interesting, right? Now, as I hover above this one, you can see on the right here, we have a strike of 590. We have a net gamma of negative 756 million. We got put open interest at 129,000 and call open interest at 70K. So that means that the puts are winning at the 590 strike right now. Very interesting and very telling. We also have a higher call volume for the 594 strike. Very interesting. Remember, we talked about that on the chart, that 594 on the daily chart was an area for me to buy calls to swing to the upside. All right. And it's all going to make sense when we get back to the chart. Here's an expected move. All right. What is the expected volatility move for SPY going forth? You have a February 21st expiration date, right? A month away. SPY has an expected move of 608 and a lower price of 574, which we also talked about the line in the sand for puts, for is no more support at 574 if we drop below. All right, we can see big drops, but I'm not saying we can. I'm just saying a scenario. 608 by February is an expected move. 615 by March 21st is the expected move, and 620 is the expected move by April 17th. That's why I love leaps. The market is always going up unless we have some sort of recession, and I'm not calling for that, all right? Unless the bond market, the TLT, starts doing its thing. Now, let's quickly recap. We talked about 594 being the gamma for calls. We talked about 591 and 590 being for puts. All right, and what do we have here? Let's go back to the daily so you can see this and understand this. Does it have to be hard or complicated? As you can see, my drawings are still here. Still here. What is this number on the bottom of this candle right here? What is that? That number is 589, 590, and 591 is right here. We are still above the 21. That's the area, right? This is the little baby range that we talked about, the little risk to reward that I don't like for those puts, right? All right. What is the top number here? 594. All right. There's no other place rejecting it besides here. So you can get that squeeze with this simple line break, this red line, dotted line, dashed line. That's called a simple line break. It's simple, but in nature, it's power behind that because price is getting above these highs. Buying pressure is coming into the market. Gamma squeezes occur. We already talked about this. Okay. This is what you want to look for. So watch out for the gaps for tomorrow that could be filled. Watch out for the traps. We could burst to the upside. And tomorrow is Opex expiration. And so sometimes that means that the market makers like to drive price to these max pain areas. So we could see chop all the way up until the end of the day until the market imbalances. All right, at 350, when the market imbalances come in and you get buys and sells on the entire market. Okay, guys, I appreciate you watching. Appreciate you taking out the time to listen. And if you stay with me this far, then that means that you were very dedicated and the video meant something to you. My name is UV the Great, and I am brought to you by the Unique Trading Group, where we talk about stocks and live commentary. So if you want to join the family, the link is below in the description. If you like the video and you found it valuable, don't be scared to like and subscribe and share with your friends and or your family. All right? And till the next time, peace.